Well, Treasury Secretary Scott Bessent is blaming the Biden administration after credit rating agency Moody's downgraded the U.S. on Friday. The agency cited concerns over the growing deficit in moving the U.S. one level below its AAA rating. It said, quote, successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits. Here's what Bessent had to say yesterday.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. Larry Summers and I don't agree on everything, but he said that when they downgraded the U.S. in 2011. So it's a lagging indicator.
And for more on this, we're going to bring in Javier David. He's the business editor at the Dallas Morning News and a CBS News contributor. Javier, always good to see you. So what do you make of Bessent's comments there?
Entirely what you would expect. It's not without merit. Incidentally, kind of a fun fact, the last 3 successive presidents have seen a credit downgrade meted out on their watch, and precisely for the same reasons. So S&P in 2011, Fitch in 2023, and now under current President Trump. So, look, this is the big takeaway is debt and spending dynamics are unsustainable. They've been on that trajectory for quite some time. Washington has simply just kind of run out of road down which it keeps kicking this proverbial can. So that's not news. This time, however, the circumstances are entirely different. There was no tariff war and investors weren't sort of quote unquote selling America the way they are now.
Now, Javier, I think the big question a lot of people have is how does this credit downgrade impact average Americans?
Well, look, the market's reaction is what you would expect, which is the sort of knee-jerk sell-off. And analysts some point out that the downgrades don't always have a lasting effect on prices. But the surge in long-term bond yields is telling you exactly what you need to know. Those rates are inextricably linked to credit cards, auto loans, which means you won't expect any relief on that front. Anyone hoping for a more reasonable mortgage rate as a first-time buyer or even as a refinancer, hopes are also dimmed there, unfortunately.
Now, Javier, you mentioned credit cards. I want to turn to something that's been going on in that industry. Capital One officially closed its acquisition of Discovery on Sunday, $35 billion deal here. So if you're a consumer who you've got a Capital One card or Discover card, how does this impact you?
Look, so in context, there are 4 brands that dominate the global credit and money transactions market. Discover has a very small sliver of that, maybe in this low single digits. So Visa, far and away the leader. Amex isn't as big as Visa or MasterCard, but they cater to a very specific market. So in instances where you see this, Capital One is one of the largest credit card issuers in the U.S. behind JP Morgan and Citi. So it has a range of consumer credit-driven businesses, savings, auto loans, mortgages. It gives them a little bit more cash to sell some of those products. What this means for them is they actually now have an entry and they have room to expand a little bit. But they're, you can probably as a consumer expect that you're going to get a little bit more if you're a Capital One consumer, a few more offerings, and you'll probably get a little bit more in terms of things getting in your inbox, like to sort of sign up to Capital One.
All right, Javier David, thanks so much for joining us.
Sure.